Winston and Felix here, and Winston wanted to give you a quick update on the Credit Suisse saga. It's not getting as many headlines as it was, and I wonder if that is intentional. Bloomberg, for example, running its stories, but in quite a friendly way, and of course Credit Suisse is a very major Bloomberg client, not just for the terminals, but also for the advertising side. So you always have to bear that in mind with media. They don't want to panic in the financial industry, do they? I don't want it either, quite frankly. There isn't really any benefit in us for it, but what you have to look at is what they're looking at now. They're looking to split Credit Suisse into three parts. Looking to sell off the structured products division. They're looking to re-establish a kind of niche boutique investment bank under the old First Boston name, and then Credit Suisse is sort of left with the rest of it. The problem, of course, is that they've lost 60 deal makers in the investment bank division over the last year since the Archegos disaster and all the other scandals that they've had. So who wants to buy that? In the past, there would be Saudi or Qatari funds that would sort of step in and pick up, good quality assets at a discount, pay a bit of capital in, lend some money at a high interest rate, and that might be the way out for them if they can find that. Why? Because they need about $4 billion just to restructure. They've paid out $1.3 billion just to retain some of the staff wanting to leave in the last year and a half or so. So this is an expensive business to run, especially when you're not doing much and you're losing deals. And think about the wealth clients. I mean, would you stick around with this lot? I wouldn't. I'd certainly go somewhere else. In fact, I'm doing the same thing with even other Swiss banks, just by approximation. So what is it all telling you? Well, typically when Fed rates rise substantially in the past, think 2008, think 2000, something tends to break in the economy. There is some sort of scandal, some sort of idiocy in the financial services industry that's been hushed up for a few years, low interest rates that allow that, and then suddenly the reality kicks in and somebody or other needs a bailout. And we haven't had that moment, and it's a bit of a surprise. This is the first lot that's sort of popping up here, Credit Suisse. And with trillions of credit derivatives that nobody really understands, that is a little bit my concern here. So I am staying away from financials as far as I can, and I'd urge you to look into the unknown risk that lies in these banking giants. So be a bit careful with that, tread a little bit carefully with that. But forward PE ratios for S&P 500 stocks are looking pretty appealing from my perspective. Now that's all Winston's view, so none of that is financial advice. Any last thoughts, Winston? No, Winston's looking out to the sea thinking, how can I get in there? Let's go for a swim, but these rocks are a little bit steep even for little Winston. So thanks for watching, thanks for tuning in. I'd appreciate a subscribe if you want to get us to 40,000 subscribers. We're almost there, and thanks, and see you on the next one.